So on just, an entirely average day, there is over 32,424 crore rupees changing hands in this one specific marketplace.
Yeah, that's just the baseline.
Right, exactly. And on a busy day, like a peak day when global markets are panicking about something, we're talking about a staggering 1.9 lakh crore rupees moving back and forth, just in a matter of hours.
It's hard to even wrap your head around that number.
It really is. But the crazy thing is, like, if you try to find the loading docks for this market, or if you go looking for, I don't know, convoys of trucks backing up to deliver bars of gold, or these massive pipelines pumping barrels of crude oil into holding tanks, you won't find a single one.
Nope, not one.
Because nothing physical is actually moving, like, at all.
Right. It is just pure financial velocity. What you're describing, it's basically a frictionless digital layer that's suspended entirely above the physical reality of the global supply chain.
And that invisible engine is exactly what we are unpacking today. We are doing a deep dive into the business model, the underlying unit economics, and the, well, just formidable competitive moat of the Multi-Commodity Exchange of India, or MCX.
Yeah, it's a fascinating piece of infrastructure.
It really is. Now, let me just set the parameters for you right up front. We are examining this strictly as a fascinating study of a business infrastructure. We are absolutely not giving you an investing lesson today.
No, definitely not.
And this is 100% not a tutorial on, how to trade derivatives or manage a portfolio.
Right. We are looking at the architecture of the exchange itself as a corporation. How it captures value from the ecosystem, the actual mechanics of its revenue generation, and why it holds this almost, well, monopolistic grip on the Indian commodity sector.
Exactly. And to do this, we are synthesizing a really big stack of thorough business and growth analyses, plus some financial records going up to the third quarter of the 2025-2026 financial year, and some incredibly detailed competitive teardowns.
Lots of data to get through.
Oh yeah, tons of it. So okay, let's unpack this. To understand why you should care about this invisible engine that's powering India's commodity ecosystem, we really have to look at what MCX actually built.
Right. So basically, they operate a digital platform for trading commodity derivatives, mostly futures and options.
And the scale of the categories they cover is just massive.
Oh, it's huge. They essentially segment their market into four major buckets. So first you have bullion, which covers your gold and silver contracts.
Right. The heavy hitters.
Exactly. Then you have base metals. That's your aluminum, copper, lead, zinc. Then there is energy, which is predominantly crude oil and natural gas. And finally, agriculture, which includes commodities like cotton, mentha oil, and castor seed.
But the critical mechanism here, the reason there are no loading docks, is that these contracts are almost universally cash settled.
Yes, that's the key.
So if a major jewelry manufacturer in Mumbai buys a futures contract for gold on MCX, no one is actually dropping off bullion at their headquarters when that contract expires.
Right, because they don't want the physical delivery from the exchange. I mean, they already have their physical supply chains established.
Makes sense?
Yeah, they are using the exchange purely for price discovery and risk transfer. And the ecosystem is just heavily institutional and professionalized. Like there is no direct retail access where an everyday person can just, download the MCX app and start buying crude oil.
Right, you have to go through a broker.
Exactly, a SEBI-registered broker. And the gatekeeping is intense.
Oh, I bet.
Yeah. The entities that actually hold trading and clearing rights directly with the exchange, they're called trading cum clearing members. They are required to maintain a minimum net worth of 75 lakh rupees just to be allowed onto the network.
Oh, wow. 75 lakh rupees.
Yeah.
Just to play in the sandbox.
Basically, yeah.
So you have this highly capitalized, very sophisticated user base, right? You've got brokers, professional hedging firms, arbitrageurs, and they're all trading these digital contracts that represent massive volumes of real-world materials.
And what's fascinating here is the genius of the MCX revenue model. They are entirely agnostic to the outcome of these trades.
Right. They don't care who wins or loses.
Exactly. They don't care if, a geopolitical crisis sends the price of crude oil to the moon, or if some massive oversupply crushes the price of zinc.
Because they have zero inventory risk.
Zero. MCX does not buy gold hoping the price appreciates. They just simply operate the digital arena.
Okay.
Their revenue model is purely transaction-based.
It's like a toll booth.
Literally, every single time a contract changes hands, they levy a fixed fee. And depending on the commodity and the lot size, it ranges from just 1 to 20 rupees per lot.
It's so small.
It is. I mean, they also capture clearing and settlement fees, membership fees, and data vending income. But that tiny microscopic transaction fee is really the beating heart of the business.
It's just incredible to think about. It reminds me of like a casino or a massive financial toll booth on a super busy highway. You pay this tiny toll, just 1 to 20 rupees, to cross. But when millions of cars are crossing every single day, it turns into a massive cash machine.
And when you aggregate those 1 to 20 rupee fees across millions of trades, the leverage is just breathtaking.
Totally. I mean, look at the 2019-2020 financial year. The total turnover on the exchange was 83.98 lakh crore rupees.
Which is just a staggering amount of money.
And that turnover generated their fee base without them taking a single rupee of principal risk on the underlying assets.
Yeah, it's the ultimate toll booth model, but stripped of all the physical maintenance costs. Like, they don't have to repave the highway. It is pure operating leverage. They build the digital matching engine, they maintain the server uptime, and then they just process the traffic. And the marginal cost of processing one additional trade is, well, it's virtually zero.
But 83.98 lakh crore rupees, as astronomical as it sounds, is actually just a drop in the bucket compared to what the market could be.
Yeah. Oh, absolutely. It's a fraction of the structural ceiling here.
Because when we look at the total addressable market, the TAM, the numbers get almost surreal. Like the analysis we're looking at estimate the TAM for commodity derivatives in India to be somewhere between 200 to 500 lakh crore rupees annually.
Right. And to put that 500 lakh crore rupee figure into perspective, India's entire physical GDP is roughly around the 300 lakh crore rupee mark.
Wait, really? So the theoretical ceiling for the derivatives market is actually larger than the total economic output of the country?
Yes, exactly.
That is insane. And yet, the current organized penetration, so that's the combined turnover of MCX and its domestic counterpart NCDX, is sitting at only about 100 to 150 lakh crore rupees.
Yeah, so we are looking at a scenario where 85 to 95% of the total addressable market is completely untouched by formal digital exchanges.
How does that even happen? How is the TAM so big?
Well, the mechanism behind that massive CAM number is the leverage multiplier. So analysts don't just look at the physical size of the commodity market, which is around 50 to 75 lakh crore rupees in India.
Okay.
In derivatives, you trade on margin. You might only need, say, 10 to 20% of the contract's total value in cash to actually hold the position.
Oh, right, because you aren't buying the whole physical asset.
Exactly. So that implies a leverage multiplier of anywhere from 5x to 10x. In mature global markets, like the ones operated by the CME Group in the United States, the derivative turnover is routinely 10 to 20 times the size of the underlying physical market.
But India is only operating at a 2x to 5x multiplier right now.
Right. The market just hasn't fully financialized yet, and the penetration is wildly uneven depending on what material you're actually looking at.
Yeah, the sources pointed that out. Bullion has a relatively healthy penetration rate of 20 to 30%.
Which makes total sense given India's massive cultural and economic affinity for gold.
Yeah, and you have these sophisticated jeweler networks that really need to hedge against global price volatility, so they are actively using the exchange.
But the glaring anomaly, the thing that really stands out, is agriculture.
Yes. Here's where it gets really interesting. Agriculture constitutes roughly 15 to 18% of India's GDP. Right? It is the backbone of the physical economy.
Absolutely.
Yet the organized derivative penetration for the agricultural sector is hovering at less than 2%.
Less than 2%.
The disconnect there is just fascinating to me. Why is that? You have this hyper-modern, high-frequency digital exchange, and it has almost completely failed to penetrate the largest sector of the physical economy.
Well, the friction isn't technological, it's structural. The Indian agricultural market is really defined by millions of smallholder farmers, incredibly fragmented supply chains, and local informal cash markets, the mandis.
Right, and standardization is the enemy of fragmentation.
Exactly. To trade a futures contract, you need absolute certainty about the quality, the grade, and the delivery mechanism of the underlying asset.
Because if you buy a contract for a specific grade of cotton, you need to know that the physical equivalent actually exists and is priced transparently somewhere.
Right. And in a cash-based, bilateral, highly localized agricultural economy, creating that standardized benchmark is just incredibly difficult.
Which means the upside for an exchange like MCX isn't just about, launching a new app feature or something. It relies on a macro-level formalization of the entire Indian agrarian economy.
Yeah, if even a tiny fraction of that 80 to 90% of informal agricultural trade actually moves into standardized, digitized channels, the
Hmm.
volume growth for these exchanges would be historic.
And MCX is actively trying to build the plumbing for this, aren't they?
They are. They have over 1,100 access points scattered across the country, basically attempting to funnel that localized physical flow into their centralized order book.
But currently, they are capturing perhaps, what, 5 to 10% of the total physical commodity value across all sectors?
Something like that. The remaining 90% is the great white whale for these platforms.
But, while that uncaptured market is vast, the portion of the market that IS captured is completely dominated by MCX.
Oh, completely. They hold a staggering 92% market share in commodity futures in India.
92%?
Yeah, based on 2021 data, but still, that kind of dominance leaves the domestic competitors like NCDX just fighting over the highly complex, low-margin agricultural scraps.
Right. While global data players like Moody's merely provide analytics on the periphery, they aren't even competing for the core trades.
Exactly.
And we can see that dominance reflected in the equity markets, too. Looking at a 12-month trailing period in our sources, MCX stock delivered a 144% positive return.
That's huge.
And over that exact same window, Moody's was up just 2%. CME Group was up 2%. So MCX outperformed the global giants by over 140 percentage points.
Which doesn't just happen by accident. It is the result of a virtually impenetrable competitive moat.
So what exactly makes up that moat?
The foundation of that moat is what we call network density, or, the liquidity network effect. In a matching engine business, the primary product isn't actually the software interface. The product is the presence of other traders.
Right, because of the bid-ask spread.
Exactly.
Like if you want to sell a massive position in gold and you go to a newly launched competitor exchange, there might only be a handful of buyers in their order book.
Right, it's an empty room.
Yeah, so to get them to take your massive position, you have to drastically slash your asking price. The spread between what you want and what they will actually pay is incredibly wide. And that spread is essentially a hidden tax on the trader.
But if you take that exact same position to MCX, you are basically stepping into a stadium with hundreds of thousands of active algorithms and institutions shouting bids simultaneously.
So the spread just collapses to a fraction of a rupee.
Exactly. You get fair market value instantly. Liquidity begets liquidity. Traders just naturally flock to the deepest pool because it is mathematically the cheapest place to execute a trade.
Which in turn makes the pool even deeper for the next person who shows up. It's like a social network, right?
Right.
Or a crowded party. If everyone is at the MCX party, nobody wants to go to the competitor's empty house down the street,
Yeah.
even if the drinks, or the fees in this case, are slightly cheaper.
That's a perfect analogy. It is a self-reinforcing monopoly.
Yeah.
The stadium itself is the product. Even if a competitor builds a faster matching engine and offers zero transaction fees, it doesn't really matter. A faster engine with no counterparties is totally useless.
And MCX locked in this density really early on, didn't they?
They did. They aggressively engineered products tailored to the specific psychology and the capital constraints of the Indian market.
Right, they didn't just copy-paste global contracts from Chicago or London.
No, they introduced 40 distinct products. That includes mini and micro variants and specialized contracts like the gold pedal.
The engineering of the gold pedal contract is just brilliant.
It really is.
Because a standard global gold futures contract requires a massive amount of capital to trade. But by creating these smaller, custom lot sizes, MCX made hedging accessible to the smaller Indian jewelers and the retail traders.
They effectively built a walled garden. Those traders can't just take their micro contracts to the CME Group in Chicago because the specs don't match. They are locked into the domestic liquidity pool.
Wow, that's so smart.
And furthermore, MCX pioneered evening trading sessions for energy and bullion products.
Oh, right, because crude oil and gold are globally traded.
Exactly. Meaning price-moving news often breaks during U.S. or European market hours, which is long after standard Indian business hours.
So by extending their sessions late into the night, MCX allowed domestic hedgers to actually react to global volatility in real time.
Yes, cementing their status as the indispensable one-stop liquidity hub.
And because nobody is leaving that stadium, MCX possesses absolute pricing power. They don't have to burn billions of rupees on marketing or user acquisition.
No, they don't.
Which brings us to arguably the most jaw-dropping aspect of the MCX architecture, and that is the unit economics.
Yeah, the numbers here are wild.
When you hold 92% market share in an asset-light, high-leverage business, the financial statements look less like a traditional company and more like Well, a toll booth attached to a money printer.
The operating leverage is entirely structural. They run a very high fixed cost base against a highly scalable volume-linked variable revenue stream.
Okay, let's break down the mechanics of that. Their fixed costs are things like the data centers, the thousands of servers running the matching algorithms, the cybersecurity infrastructure, and, the salaries of the engineers keeping the system online.
Right.
And if average daily turnover is 10,000 crore, or if it suddenly spikes to 1 lakh crore, the cost of powering those servers remains virtually flat.
Exactly. And their variable costs, the expenses that actually scale alongside trade volume, are incredibly suppressed. They primarily consist of just minor clearing charges and some software licensing fees.
And this dynamic creates a structural EBITDA margin of 80 to 90% at scale.
Which is astronomical. For every 100 rupees of incremental revenue generated during a volatile market swing, 80 to 90 rupees falls directly to the operating profit line.
We saw this engine running at maximum capacity in the third quarter of the 2025-2026 financial year. The numbers are just explosive.
Yeah, they posted 666 crore rupees in revenue for that quarter alone.
121% increase year over year.
And the underlying driver for that was an average daily turnover, or ADT, that hit 7.5 lakh crore rupees. That ADT figure was up 220% year over year.
Okay, wait, the divergence between those two numbers is where the nuance of their cost structure actually reveals itself, right?
Yes, exactly.
Because volume grew by 220%, but revenue only grew by 121%.
Right, and that gap is explained by the product mix and the actual mechanics of data licensing.
This is a crucial detail from the sources. If a trader executes an energy contract on MCX, say natural gas or crude oil, MCX does not own the underlying price benchmark.
Right, they have to license that pricing data from global exchanges like the CME Group.
And that royalty fee eats up roughly 5 to 10% of the revenue generated from that specific energy trade.
However, if that same trader executes a bullion or a base metal contract, MCX pays a 0% royalty.
Oh, wow. Because they control the domestic pricing mechanism.
Exactly. So the margin on a gold trade is significantly higher than the margin on an oil trade. So depending on what global macroeconomic event is driving the trading volume on any given day, their revenue capture rate actually fluctuates.
Makes sense. But regardless of the mix, the sheer scalability of the free cash flow is staggering. So what does this all mean? It means because the business is fully digitized, there is zero working capital risk.
None. They do not carry physical inventory that can depreciate or, spoil.
Right. No warehouses of rotting grain.
Exactly. And they do not have complex accounts receivable where they are waiting 90 days for a client to pay an invoice. The transaction fees, those tiny 1 to 20 rupee tolls, are automatically debited from the members' clearing accounts on a daily basis.
So free cash flow is essentially equal to net income,
Yes.
which allows them to generate a return on equity, or ROE, that structurally sits between 40 and 60%.
It's incredible.
To contextualize how dominant that is, our sources compare MCX's Q3 FY26 standalone profit growth of 125% against the broader capital markets industry average.
Right?
Over that exact same period, the average profit growth for the capital markets sector was a mere 4.1%.
4.1 versus
Yeah.
a 125.
Yeah, MCX isn't just beating the industry, they are operating in a completely different atmospheric layer.
But an engine cannot run indefinitely on the fuel it used yesterday.
Right, very true.
The massive 220% volume spikes we just talked about are heavily reliant on external geopolitical shocks, a sudden war, an unexpected OPEC decision, some global supply chain crisis.
So to build compounding structural growth that doesn't rely purely on global panic, MCX has to engineer new avenues for capital to flow into their ecosystem.
They need to build more lanes on the highway.
Exactly. So where do they go from here? What does the next decade of growth look like? Well, the sources outline a multi-pronged expansion strategy, starting with the launch of entirely new financial instruments.
The most significant structural innovation here is the expansion into electronic gold receipts, or EGRs.
EGRs. Okay, let's unpack the mechanics of an EGR because it's a fascinating piece of financial engineering.
It really is. This is a mechanism designed to bridge the gap between the massive physical gold reserves held by Indian citizens and institutions and the digital derivatives market.
Because right now, those two things are kind of separate.
Right, so instead of buying a futures contract that settles in cash, an institution can take physical bars of gold and actually deposit them into a SEBI-registered vault.
Okay.
The vault verifies the assay, the purity, the weight, and then they issue a digital receipt, the EGR.
And that receipt can now be traded on the MCX platform just like a stock.
Exactly. It creates total fungibility. The EGR represents a verified physical asset sitting securely in a vault, but it trades with the speed and the fractionality of pure data.
And critically, at the end of the chain, a buyer can surrender the EGR back to the vault and withdraw the actual physical gold.
Right, so it connects the spot market directly to the exchange ecosystem, pulling all that physical liquidity into their digital orbit.
Wow. And alongside EGRs, they're launching index futures and options, right? Like MetalDex for a basket of base metals and BullDex for bullion.
Yes, and the introduction of options contracts in particular has been just a massive catalyst.
Because giving a trader the right, but not the obligation, to buy gold at a future date requires a fraction of the capital of a standard futures contract.
Exactly. When MCX introduced bullion options, the average daily turnover for the options segment jumped 5x year over year.
5x.
Yeah. It proves the latent demand is absolutely there. They just need to build the right, highly leveraged product to unlock it.
And beyond product engineering, they're also engaging in strategic ecosystem expansion through partnerships, right?
Right. A prime example is their revenue sharing agreement with the Indian Energy Exchange, or IEX.
Yeah, MCX agreed to hand over 10% of the revenue generated from energy derivative settlement to IEX.
Which, at first glance, for a monopoly to surrender a 10% slice of a highly profitable vertical, it seems totally counterintuitive.
It does. But the game theory behind it is brilliant. They aren't just giving away margin for nothing.
No.
By integrating the settlement infrastructure with IEX, which is the premier spot electricity market in India, MCX is actively facilitating a deeper, much more integrated liquidity pool for the entire energy sector.
They are sacrificing 10% of the margin to ensure the total volume of the pie expands exponentially.
And if we connect this to the bigger picture, this strategy aligns perfectly with the underlying macro drivers of the Indian economy.
Oh, completely. We are looking at a nation projecting 50% urbanization by the 2030s, and with a middle class expanding beyond 500 million people.
Which is a demographic shift that requires massive infrastructure development, housing construction, electrification, and just huge consumer spending.
All of which mandate a staggering increase in the physical consumption of copper, zinc, aluminum, crude oil, and natural gas.
Right. And as the physical spot market balloons to meet that urbanization demand, the derivative market, the mechanism used by corporations to hedge the price risk of those raw materials, it just must scale proportionally.
And to handle that anticipated scale, MCX is undergoing a massive technological overhaul led by Tata Consultancy Services.
TCS.
Yeah.
And this is not just a routine software patch, is it?
No, it is a fundamental rewiring of the exchange's matching engine, designed specifically to accommodate higher frequency trading, or HFT, and dramatically increase message throughput.
Because HFT completely changes the nature of an exchange.
It really does. We are no longer talking about a jeweler just clicking a mouse to hedge a shipment.
Right. We are talking about institutional algorithms submitting, modifying, and canceling tens of thousands of orders per second to capture fractions of a rupee in arbitrage.
Exactly. And for HFT firms, latency, the microsecond delay between their server and the exchange's matching engine, that is the difference between extreme profitability and total failure.
So by upgrading the tech stack with TCS to achieve ultra-low latency, MCX is effectively inviting the global algorithmic trading powerhouses to connect directly to their liquidity pool.
Yes. Combine that institutional throughput with the massive influx of retail traders entering the market via all these intuitive, mobile-based discount brokers, and you have an architectural foundation capable of handling multiples of their current daily turnover.
It sounds invincible. I mean, you have a 92% market share and 80% operating margin, this massive macro tailwind of urbanization, and a newly upgraded HFT-capable tech stack.
But monopolies fail.
Right. But no engine runs perfectly forever. What are the fatal flaws that could bring MCX crashing down?
The analyses we are reviewing highlight severe structural vulnerabilities that could aggressively fracture this ecosystem.
Okay, let's look at the Achilles heel of MCX.
The single most potent existential threat is not a competitor, it is regulatory risk. Specifically, the Securities and Exchange Board of India, SEBI, possesses the unilateral authority to alter the margin requirements.
Right, we discussed earlier how the leverage multiplier, controlling 100 rupees of gold with only 10 rupees of capital is what drives the massive TAM.
But if SEBI determines that retail speculation is running way too hot, or that systemic risk is building up in the clearinghouse, they can step in overnight and mandate higher margins.
Wow.
Overnight.
Yeah. If SEBI hikes the margin requirement from, say, 10% to 20%, they aren't just making trading incrementally more expensive. They are physically shrinking the total purchasing power of the entire ecosystem.
Okay, let's unpack this. A quantitative trading firm that could deploy its capital to control 10,000 contracts yesterday can suddenly only afford to hold 5,000 contracts today.
Exactly. The liquidity instantly evaporates.
And historical precedent bears this out, doesn't it? It does. When regulators in India have previously curbed leverage to cool down speculative fervor, average daily turnover on the exchanges has plummeted by 30 to 50% in a matter of weeks.
And because MCX's operating leverage is a double-edged sword, those fixed server costs remain exactly the same. Whether volume is booming or crashing, a 50% drop in turnover essentially halves their profit after tax.
It's brutal. But, regulatory intervention is external. There is an equally devastating internal threat, which is technology disruption.
Right, because an exchange is fundamentally a trust engine. If the matching engine fails, the entire value proposition just collapses.
And the sources highlight a specific incident on October 28th where a software glitch tied to UCC limits caused catastrophic trading halts.
Let's explain the mechanics of that glitch for a second. UCC stands for Unique Client Code. Every participant on the exchange has one.
Right.
And to prevent a single rogue trader or, a malfunctioning algorithm from taking on billions of dollars in catastrophic risk and bankrupting the clearinghouse, the exchange hardcodes exposure limits to each UCC.
Yes. But on October 28th, a system failure miscalculated or just failed to dynamically update those limits. The exchange's risk management software essentially looked at solvent, well-capitalized traders and falsely determined they had breached their maximum risk threshold.
So it locked them out.
Basically.
The result is a nightmare scenario. Imagine a trader holding a massive position in crude oil. Suddenly, an international news alert breaks, and the price of oil starts violently crashing.
Right.
The trader tries to execute a sell order to close their position and stop their losses.
Right.
But the MCX software, trapped in this UCC limit glitch, rejects the order.
They're locked inside a burning building.
Exactly. They are forced to watch their portfolio bleed out for hours because the digital doors are jammed.
And the fallout from a failure of that magnitude is just immense. It triggers a cascade of broker bankruptcies if clients cannot meet the subsequent margin calls.
Not to mention it invites massive multi-crore regulatory fines from SEBI.
But most destructively, it shatters the psychological trust of the institutional market.
Because if high-frequency trading firms and massive hedgers believe the MCX platform might freeze during periods of peak volatility, which is exactly when they need to trade the most, they will just pull their capital.
Exactly. They will find offshore routing alternatives, or they will lobby for regulatory permission to trade on global venues like the CME.
And even if the tech stack operates flawlessly, there is a fascinating, almost philosophical vulnerability built into their business model.
The volatility paradox.
Yes. The sources refer to it as the volatility paradox.
Yeah.
MCX's financial performance is inextricably linked to global instability.
Right. The massive 220% volume spikes we discussed in Q3 FY26, those did not happen in a vacuum. They were the direct result of violent swings in underlying commodity prices caused by supply chain breakdowns, geopolitical conflicts, macroeconomic uncertainty.
When the world is panicking, corporations rush to hedge their exposure, and speculators rush in to capitalize on the price swings.
And volume explodes.
And MCX collects a toll on every single panic-driven trade. They are essentially shorting world peace and economic stability.
It's a crazy way to think about it, but it's true. Because what happens if the geopolitical landscape actually calms down?
What happens if global supply chains normalize, inflation flatlines, and the price of crude oil trades in a tight, predictable, boring $5 range for 36 consecutive months?
The urgency to hedge disappears. The speculative arbitrage opportunities evaporate. The average daily turnover on the exchange halves.
So their entire valuation thesis, based on 80% EBITDA margins and hypergrowth, is actually highly vulnerable to a sustained period of global economic boredom.
Yes, exactly.
We also have to acknowledge the long-tail horizon risk of technological obsolescence.
Oh, absolutely.
Yeah.
Right now, MCX is a centralized clearinghouse. They sit in the middle of every trade, acting as the buyer to every seller and the seller to every buyer, ensuring nobody defaults.
But distributed ledger technology and blockchain protocols are actively attempting to decentralize that exact function.
Right. Currently, public blockchains cannot handle the microsecond latency and the massive throughput required for high-frequency commodity trading.
But if cryptographic networks ever solve the latency problem, and institutions can trustlessly swap digital commodity contracts peer-to-peer via smart contracts with instantaneous settlement,
Then the centralized clearinghouse becomes an unnecessary, expensive friction point. The toll booth gets bypassed entirely.
which is a huge risk for the next decade. But speaking of risks, the most surprising and immediate red flag in our research isn't technological, and it isn't regulatory.
No, it is happening right now, inside their own boardroom.
The enigma at the top. Let's examine the governance structure, because this is where the pristine narrative of the monopoly cash machine starts to show serious cracks.
Yeah, the governance assessment provided in the analytical reports is stark. MCX scored a surprisingly low 5.5 out of 10.
5.5 out of 10. For a systemically critical financial institution managing trillions of rupees in notional risk, a 5.5 is deeply alarming.
It suggests profound internal instability and a culture of opacity.
Let's look at the executive leadership. The current CEO, Praveena Rai, assumed the role only 6 months prior to the latest data cutoff.
Right. She transitioned from a chief operating officer position at the National Payments Corporation of India.
And while her background in managing massive digital payment infrastructure is highly relevant, she is entirely new to the highly specialized, risk-intensive world of commodity derivatives.
And she is not an isolated new hire. The entire upper echelon of the company has been wiped out and replaced.
Really?
Yes. They appointed a new chief financial officer, a new chief technology officer, and the new CEO, all within the tightly compressed window of 2024 to early 2025.
Replacing the entire central nervous system of a monopoly at the exact moment they are undergoing a massive, complex technological migration with TCS is an incredible operational risk.
It is. This raises an important question. Is this a planned strategic succession, or is it the fallout of deep internal dysfunction?
Right. And the public disclosures do not provide a clear answer, which leads directly to the core reason for the low governance score, a severe lack of transparency.
Exactly. The most glaring omission in the data is the absolute absence of any disclosed management ownership metrics.
We have no idea if the people running the machine actually own any part of it.
Right. And the concept of skin in the game is fundamental to corporate governance.
Because if the CEO and the board of directors have a massive portion of their personal net worth tied up in MCX stock, their financial incentives are perfectly aligned with the long-term survival and the structural integrity of the exchange.
Conversely, if management holds zero equity, the principal-agent problem emerges. Executives might be heavily incentivized to pursue high-risk, short-term strategies like drastically lowering clearinghouse margin requirements to temporarily juiced trading volume just to hit quarterly revenue targets and secure their cash bonuses.
And if that risky strategy ultimately causes a systemic clearing failure 3 years down the line, the executives have already collected their bonuses and left, while the shareholders bear the catastrophic loss.
It is a massive contradiction. You have a 20-year-old pillar of the Indian financial system posting 138% trailing profit growth and boasting 51.7% net margins, yet it operates with the secretive, opaque governance of an early-stage startup.
It's so bizarre. As an outsider looking in, you can't tell exactly how the leaders are personally aligned with the company's long-term survival. There is no publicly documented capital allocation strategy.
None. The board has not provided shareholders with clear return on investment metrics for the massive capital expenditure required for the TCS technology upgrade.
And the most tangible impact of this opacity is seen in their dividend policy. Our sources highlight a sudden, aggressive compression in the dividend payout ratio, dropping to a mere 3%.
To understand how anomalous this is, MCX has historically returned a massive portion of its free cash flow to shareholders, with payout ratios historically ranging between 27 and 80%.
Now, they did recommend an 8 rupee final dividend, which sounds positive, but when you look at the sheer volume of free cash flow the business generated in FY26, a 3% payout ratio means they are suddenly hoarding an astronomical amount of cash on their balance sheet.
And retaining cash is not inherently bad if management has a high return strategy for deploying it. But without a stated capital allocation framework, the market is left to basically just speculate.
Are they building a massive war chest to acquire a competitor data firm? Are they aggressively reserving cash because they anticipate massive regulatory fines stemming from the October 28th tech glitches?
Or is the new C-suite simply paralyzing capital deployment while they figure out the business?
The silence from the boardroom is exactly what drags that governance score down to a 5.5.
They do have some structural risk mitigation frameworks in place, though. For example, the clearing and settlement function isn't managed by the parent company directly.
Oh, really?
Yeah, the MCX Clearing Corporation operates as a distinct, wholly owned subsidiary with its own independent board of directors.
Well, that separation is a critical regulatory safeguard. It creates a necessary friction between the sales engine and the risk engine.
Exactly. The executives at the parent exchange are mandated to drive trading volume as high as possible. But the independent board at the clearing corporation is responsible for ensuring that the collateral deposited by the brokers is mathematically sufficient to cover any potential defaults.
So if the parent company wants to list a highly volatile, highly risky new derivative to boost revenue, the Clearing Corporation Board has the authority to veto the settlement, acting as a firewall against systemic collapse.
Right. But that dual board structure also introduces bureaucratic inertia. You have two separate power centers trying to govern the same ecosystem, which can slow down innovation in a market where tech-driven agility is becoming everything.
Wow. So let's step back and look at the totality of what we've unpacked today. The dichotomy of MCX is staggering. On one side of the ledger, you have arguably one of the most perfect business models ever engineered.
It really is.
It is an asset-light, structurally monopolistic toll booth, standing directly in the path of India's multi-decade urbanization supercycle. It converts 80% of its revenue directly into operating profit, operating with a network density that makes it virtually impossible for competitors to gain a foothold.
Yet, on the other side of the ledger, it is an engine balanced on a razor's edge. Its hypergrowth is ironically dependent on global conflict and supply chain dysfunction.
It operates under the constant looming threat of a single SEBI mandate, instantly erasing half of its liquidity.
And it is relying on a newly installed, opaque management team to execute a flawless technology migration, where a single microsecond glitch can trigger hundreds of cores in systemic losses.
It is a masterpiece of financial infrastructure wrapped in layers of intense operational risk.
Absolutely.
The next time you open a newspaper or a financial app and read a headline about gold prices hitting historical highs or crude oil futures collapsing in the wake of a geopolitical crisis, I want you to look past the physical commodity. Don't think about the barrels of oil or the vaults of bullion.
Look at the invisible architecture facilitating that panic. Realize that nestled within the servers in Mumbai, there is a digital matching engine absorbing that global chaos.
And every single time a panicked institution or an aggressive algorithm clicks buy or sell to navigate that chaos, this invisible monopoly quietly reaches out, takes its 20 rupees, and turns global volatility into a pristine 666 crore rupee quarterly revenue stream.
They don't dig the metal out of the earth, they don't refine the oil, they don't hold the inventory.
They just own the stadium where the world comes to trade the data. But I want to leave you with one final profound thought to explore long after this deep dive ends.
Yeah.
We talked heavily about the 98% of the Indian agricultural market that currently operates in the shadows. It's informal, localized, and completely untouched by digital formalization.
Right.
As India continues its relentless push to digitize its physical economy, bringing those millions of farmers and supply chains online, the total addressable market will finally begin to unlock.
It's inevitable.
And when that happens, and the derivative leverage multiplier in India finally scales from its current 2x up to the 10x or 20x levels seen in mature Western markets, a fundamental shift occurs.
A massive shift.
Will there come a tipping point where the sheer volume of digital contracts traded on the servers of MCX vastly dwarfs the actual physical reality of the commodities they represent?
It's a real possibility.
In a future where the financialized layer becomes 10 times larger, more liquid, and more influential in dictating price than the physical goods sitting in the warehouses, does the underlying physical commodity even matter anymore? If we reach a point where global commerce is entirely defined by the hyperspeed exchange of electronic gold receipts and algorithmically traded index futures, does the multi-commodity exchange cease to be a market for commodities at all and simply become a marketplace where we trade the pure abstracted data of human demand?